How high can interest rates possibly go? Hey, and welcome back to this week's episode of the Vancouver Life Real Estate Podcast and YouTube channel. Today, we are discussing inflation and interest rates, as this morning, the US came out with their latest reading and it came in at 8.6%. That is your year-over-year inflation rate. That is the highest print they have seen in 40 years. At the time of this recording, and this is early morning here on June the 10th, the Dow immediately impacted, all the markets impacted. Dow Jones down almost 800 points today alone. NASDAQ sitting at about 27% down on the year. It is having wide and far-reaching impact on people's wealth and their bottom lines here. Understandably, Canada is likely going to print higher as well. And so the central bank, with their next meeting here, they are likely to announce another half-point interest rate hike. But the rumors are already flying that it could be a 0.75% hike. This is quite a bit higher than we were to start the year at 0.25%. This would bring us up to either 2 or 2.25%.
Does anyone, Dan, does anyone
yeah.
know what's going on? Like, there's expectation that, economists are saying, hey, inflation is likely going to curb. Some of this is transitory. Don't worry. I'm sorry. It's time to worry.
Agreed. I mean, look, you got the Canadian 5-year bond the yields have just pushed to a 14-year high today. We're sitting at about 3.3%. Understandably, this is going to have two likely outcomes here. First being that fixed mortgage rates are going to increase, sitting at about 4.5% today. And like we said, we can expect more hikes from the Bank of Canada. Their next announcement is July 13th. 0.75%. If they're going to see a higher print for the inflation, just like the States did, they may feel very warranted in pushing to that upper level.
Yeah, I mean, it's crazy. I mean, the last time, this sort of thing took place, it didn't just correct overnight either, right? And there's likely going to be a lot of pain moving forward here. We know the Bank of Canada's mandate is to keep inflation between 2 and 3%. And if the Federal Reserve is kicking around 8.6%, then what are we doing? I mean, it's kind of terrifying me, because when you look back at the 80s, the mid 80s and the mid 70s, we actually looked at some charts back then, because it's really the only time where inflation had spiked like this was back in that time, 40 plus years ago. And I can tell you that it didn't come down right away. And it looked like they tried to fight it several times, and it was persistent and pushed right beyond the measures that were taken. In the 70s, from the mid 70s to, the early 70s to the mid 70s, we saw inflation run as high as I think it was 10%. And then in the 80s, it ran up past 14, 15%. These rises and falls took between 3 and 6 years from their start to their finish. So if the Bank of Canada has really come out and said that this is transitory and due to COVID and stuff like that, and Dan, we should also note that the Bank of Canada still has not come out and said that we printed 35% more money into our system. These are things that, honestly, there's huge repercussions for putting that amount of money into the system that quickly, and it's still gonna go up, in my opinion, right?
It's certainly looking that way. Nothing is feeling cheaper. All the supply chain issues that have been discussed over the last 18 months are largely still in existence. Ukraine war, still a massive variable, and their exports, of course, are the impacts of what they aren't exporting. And same, of course, with Russia is going to be felt in the next couple of years, because that's not something that washes out quickly either.
Well, and to your point, some of this is also domestic policy that's done this, right? Like, gas prices are the way they are because we chose not to put pipelines in the ground, right? Oil or Russia produces 10% of the global oil supply, right? So, markets should be able to absorb some sort of hit there. We have a massive amount of oil here in North America, and we don't have the Keystone XL pipeline. There's a lot of things that we could do to try and manage our own costs here that domestic policy has created a big problem for, right? And it's just because we typically don't have enough information about what the truth really is around these things. But
Yeah,
anyhow.
it's true. So we do know that the Bank of Canada tries to keep inflation between 2 and 3%. It broke out of that range around spring of last year, 2021. So we've now had a year of it almost going straight up here, and don't think this is the height of inflation yet. Um, do we remember too when we talk about time frames and the Bank of Canada's statements? I mean, sure, hindsight's 2020, but it was about mid 2020. Speaking of that, there where they came out and said, "Look, we're going to keep rates low for a very long time. So if you're thinking about a major purchase, we're going to have your back."
Mm-hmm.
That
No,
was
no,
2 years ago. Well, that's it. And as we know, people did. They listened and they went
Yeah.
out and they bought homes in record numbers. 2020, 2021, more homes bought than any other year on record. Okay. So now they're raising rates at this alarming rate. And, where was that promise that they made 2 years ago? It's kind of just been thrown out the window here because now inflation's more important than people taking out credit and buying homes,
Mm-hmm.
understandably. This is making it hard for people to maintain their monthly payments, if you will.
Yeah.
As we know, if let's say you had a variable mortgage that was attached to the rate, but not the floating fix, so your payments stayed the same, but your payments were actually going up, which a few banks can do, or you can choose to do that. Your payments, again, on your average 800K mortgage are up about $800 a month already. That's an additional almost $10,000 a year in payments for that same home. You're not going to feel very much like what they said 2 years ago is valid today and understandable.
Yeah.
Um,
There goes your trip to Mexico.
yeah, or your grocery bill or
Mm-hmm.
anything else. It's
Yep.
people are obviously and understandably retracting right now.
Yeah.
Um, I think that, of course, inflation, as quick as it is spiking, I think it's going to fall as quick. Again, we're not at the top, and it's been a full year of increases outside of the 2 to 3% band. So when we say fall quick, I think it's going to emulate the way up. And the charts from the 70s and 80s that Ryan's referring to do about the same, I would say,
Mm-hmm.
give or take a bit. If it took 2 years to go from where they wanted it to the peak, it took around that same time to fall back down.
Yeah.
So
Yeah.
as of today, general bet here that if inflation started to print lower next month, you could expect it to not hit the 2 to 3% band until likely June, July, somewhere around summer of 2023.
Mm-hmm. Yeah. And that's if they get it under control, right? And they were hoping to get it under control last time. It's not. I mean, they were. I don't have a lot of faith because, they dropped rates in the pandemic, and they got that wrong. They're getting this wrong, in my opinion. And I honestly think if it continues on the way it's going, the chances of us seeing a recession are going higher and higher and higher, right?
Agree. Yeah, recession's all but a guarantee at this point. You just can't go at this rate and not have that outcome. The metrics are, some people you could almost say a recession is in place now by a few of the metrics, but
Mm-hmm.
we're here to also to talk about housing, so, and of course, this is one of the biggest impacts on housing is interest rates.
Mm-hmm.
So we're already seeing this decline. February, March was clearly the peak here in Canada and here in Vancouver, and things have started falling ever since. We saw a median house price drop in May of 7%. There's about an additional 3% already this month. So off of those peaks, we're down about 10% on average. And again, we are talking average homes, and obviously we're going to get a little bit deeper into price points and types of homes and how they're differently affected. But again, to talk in generalities here, 10% down is about what's happened so far. HPI is just starting to tick down, but as we always mention, that's a lagging indicator.
Mm-hmm.
And And you got to think these 7-10% that we're talking about, this is largely before the June 1st announcement. So that 0.5% hike that we saw come into play at the beginning of this month, we have yet to even really see the ramifications there.
Oh,
And
for
then
sure. We haven't even felt that.
that's it. And they're going to hike again here in another 33 days. And then that's going to take a few months to fully impact the market. But everything that we're seeing now is that homes are being more and more expensive to buy based on your mortgage qualifications and what your purchasing power is allowing for. And that
Hmm.
understandably is going to keep pushing the average and the top end prices down and quickly.
Yeah, I mean, you also got to look at it too. I mean, people are down in a similar amount or more in the stock markets too, right? So when you combine those two effects, which a lot of homeowners have some holdings in other markets too, this is going to stop people moving. Right. um, Oftentimes, guys, when we see these kinds of movements, people just sit in place. They typically stop moving, they stop doing what they're doing, they go into risk mitigation mode. You're going to start to see people hoarding on to their cash because even though in an inflationary environment it's not a great thing to do right now with everything else being problematic. And prices are in homes are going to continue to fall. In fact, I think they're going to continue to fall. If we see a 0.75% hike, Dan, it's going to be winter in the real estate market almost overnight.
Agreed. And like I said, we're seeing the early signs of this already. I mean, you look at Toronto sales volumes, which is the first thing to drop off, are down 34% in just the last 3 months alone.
Whew.
That is driving up inventory extremely fast. Toronto inventory is up 270% year to date. Yes, it came off of a very low baseline, but still, that is a crazy fast rate of increase here. And it's actually the quickest or largest dating back to the 90s. So similar to, we're talking 30, 40 years for inflation, 30 years, we're starting to hit those kind of metrics in the housing market too.
Mm.
Vancouver, it's happening as well. Not to that rate yet anyway, but what Vancouver inventory has about doubled year to date here. So we're up about 100% compared to Toronto's 270%.
My goodness. I
Yeah.
mean, and it's likely that we're going to see that continue. I hate to say it, but we're going to see inventory continue to pile up because buyers are getting less and less for the money they're loaning. And until that makes sense in terms of what they can buy, and really it's psychological for a lot of people to buy when everybody else is buying, even though that's the worst time to buy. Right? When markets correct and prices come down, logically it makes sense to buy, but psychologically it's very difficult because everybody's terrified of what the outcome might be. I think it's important for us to also remember that housing is really the backbone of Canadian industry in many ways. I mean, it's one of the biggest single sectors we have in our GDP, right? So, yes, there's fluctuations. Yes, it's scary, but I still caution people against panic selling or panic buying right now. We're not in either of those scenarios yet. This is a hodl scenario. This is hold on, stash some cash because the thing that kind of really scares me is like in 3 to 4 years, if this doesn't get settled and we're renewing a bunch of mortgages at that time, that's where this starts to get really scary, where people took out 1.5 million in terms of mortgage capacity, and now they got to service that at 5% as opposed to 1.5%. Well, your mortgage payment's going to go up by 40, 50, 60, but double, right? And that'll likely break the backs of many people in and their finances, which means more inventory will hit the market, right? And further push prices down. So they got to be really careful with this, because, like I said in our last podcast, with the amount of leverage in these cities, the government has to be very careful doing things like a 0.75% increase. Very careful, because it's going to just kill things. It's going to kill it.
With so many people buying homes over the last 2 years, and yes, like you said, the renewals coming up now within 3 to 4 years type of time frame, the Bank of Canada is very aware of this too. And I think it could potentially be a bit of a target that they're not discussing openly, but that, look, they need to raise quickly now, get inflation under control. And then there's going to be that, 18, 24-month window starting in a couple of years here that people will need to renew. And if the rates haven't come back down by then, yeah, it's going to be very challenging for people to be able to afford their new payments. And like you said, there's going to be a massive um, I guess, release of homes in that time frame.
Mhm.
And of course, if inventory does accumulate incredibly rapidly and coming off of maybe a mid to higher base, then yes, prices would understandably have extreme downward pressure.
Yeah.
So way too early to tell where we're going to be here in 3 years, but I think this is something that is on the radar that they're very well aware of. So
And I just want to finish one last point to that because it is positive. It's not all doom and gloom. Canada still remains one of the few sought after places in the globe to come to set up your family, and our immigration is incredibly strong. So 450,000 permanent residents per year, and the government is hitting those targets no problem. So there's still going to be demand, right? It's how quickly can we put people into a permanent residency status so that they can start participating in the property market. That will help to balance prices. Vancouver is typically a very resilient city in that respect. Prices don't typically come down and last down at the bottom very long. So um, it's scary in terms of where we're headed. But there are, you know, um, other factors at play here that can help to hopefully soften the blow. I guess we'll see.
yeah, sure. If you want other positive news, I mean, unemployment rate came out again today here for Canada, and a new all-time low.
Mm-hmm.
And a whole point, or sorry, yeah, 0.1% lower. And so again, lots of people employed and lots of jobs available, which understandably are attracting people to want to come to this country.
Mm-hmm.
Yeah, one thing I also want to expand on in regards to this increasing inventory too is the investor segment. Through 2021, 1 in 4 mortgages was for people buying secondary properties, whether that's a vacation home or an investment property. When the rates go up at this amount and that eats directly into your ROI and your cash flow, that segment of the market steps back. So you're going to see a lot of people sort of step back from maybe the condo market, for example, especially in Toronto. I think we're already seeing that there because their inventory is increasing rapidly. But yeah, you're gonna see different property types operate differently, because when we say, yeah, prices are down 10%, that doesn't mean every property's down 10%. Because at the end of the day, it's about affordability. And Ryan, maybe you want to expand on sort of the compression that we've been discussing these
Yeah.
last couple of days here, because again, we want to make it clear that not every home is going down in price, and there are certain segments of the market that are going to be very, I believe, consistent within their pricing, maybe even going up in the upcoming months here.
I mean, when any market goes through a significant fluctuation, um, people who have more exposure typically experience a bigger correction, right? So more expensive property, call it 2 million plus, they're more susceptible to higher correction numbers, right? Especially if they're leveraged. What's different is when you start to go down the scale. So you start to look at maybe the sub $1 million mark, and then the sub 700 mark, and then the 500K mark. Much like when, prices get too high, eventually buyers peel out and start to look at what's under, right? Right now, when prices are coming lower, it tends to compress the market as the top comes down, right? The bottom end of the market, though, doesn't typically correct in the same fashion as the top of the market. So we see this compression that starts to take place. And it's interesting. We're in an environment now where, you can buy a house and negotiate, 10 or 15% off the list price, and you're still in multiples of 500,000, right? And why is that? Well, people also want to take on less risk. They still need a house, but they want less risk. So they're not going to utilize the mortgage that they've been given. They're going to buy something less that leaves them with less exposure. That creates more competition in a different segment of the market. right?
Yeah, people still try to largely buy at the top of their budget as well. It's human nature, and we see something like 94% of people buy at the top of their buying power. And so, if 3 months ago that typically sat around 800K, well, they've been pushed down into the 700K price point range as an example, and so they're
Mhm.
going to buy in that. And so, if less people, more and more people are getting pushed down into the lower price band, well, that's where all the activity is going to largely maintain. And as we're seeing
Yeah.
even this week, those type of properties can get pushed up in price because the good ones will get snatched up, and there will be more interest in that.
It's safe to say like the luxury market in Vancouver is going to go very quiet for some time now. We've seen it historically in the past. Uh, that also may be there may be a good opportunity there for somebody with some cash to pick up a good deal there. It's not happened yet, but it's coming, right? It's definitely coming. And in that small side, on the lower end, um, while not everything is seeing competition because right now everybody's kind of taking this wait and see approach, do expect that when the dust tends to settle or we start to hear news of cresting, whether it's inflation or interest rates, one of the two, you'll start to see people step back up off the sidelines and pretty quickly, people will be trying to pick up property because that demand hasn't gone away. It's just right now people don't know if they want to pay that much, right? So they're holding off, and I think probably wise.
There you go. So, time to panic? No, but what is happening in your world? What's happening with property that you either own or might have to refinance or you're thinking about buying? We'd be happy to chat it out with you. Get a hold of us and let's explore your scenario because it is so unique person to person and we are advising accordingly. Ryan, want to wrap this one up?
Yeah, guys. Like Dan said, let's not panic. We're not there yet. It is, but do keep a very close eye on it and speak to your mortgage or your realtor professional to find out exactly where you're at. Guys, changing markets are they're very difficult to navigate, right? You have to have a very good understanding of the big picture that's taking place here. It's something that Dan and I focus on a lot of. So if you guys want to know more about your property, reach out below, leave a comment, and we'll get in touch with you. Otherwise, we'll see you guys next week, and hopefully there's some more exciting data for everyone. Chat to you guys next week.